My name is Brooks Dyroff. I'm CEO of the Street Sheet and Street Sheet Research. I'm sitting down today with Ed from ClientFirst Wealth Management. In 2007, Ed founded his company, an independent fee-only RIA and fiduciary. Ed holds a certified financial planner and the chartered financial consultant designations. He earned his MBA from the University of Arkansas and his BSBA from the Citadel. He has had many articles published in various magazines, including 5 published in Barron's, and he has been interviewed numerous times by the Wall Street Journal. In 2014, Ed wrote the book, How to Select a Financial Advisor, the Least You Should Know. Ed, before we hop on, can you tell me a little bit about your background, kind of before you were a financial advisor? So I love
Sure.
humanizing our guests. Where did
Okay.
you grow up? Where do you live now? Do you have family, pets? Tell me a little bit about
Okay.
Ed before we get into the business part.
Yes. Well, I grew up in a small town in Arkansas, Pine Bluff, Arkansas, and my family farmed. And so every summer we'd work on the farm and cotton, soybeans, and rice right on the Arkansas River. And I loved that life. But I always had an interest in markets, even as a youngster. And then in college, I was a business major, of course, and then got the MBA afterward. So kind of evolved into the financial services industry. My family continued to farm for a while until my dad exited uh, mid 90s, I guess. And I got in the securities business in 83, working for a small dealer bank in my hometown. Then worked for a regional firm, a regional broker dealer for about 12 years as an institutional fixed income salesperson. And then for a wirehouse as a financial consultant. And that was, I guess, '01 when I left. I went independent for 4 or 5 years and then decided just to go totally fee only in '07, which is how I'm presently set up as a fee only fiduciary, as you mentioned. My business has always been such a high percentage in fee based anyway. It was an easy transition, Brooks. So I live in Little Rock, Arkansas with my wife. My kids are grown. I've got a daughter that teaches college in Massachusetts and a son who's an attorney in Fort Worth. And I'm close to opening an office in Fort Worth. So I get to see him more and more and just love outdoor activities of all sorts. Anything we can do with the family, I love. And reading, and then dogs. I've had dogs my entire life. So,
Amazing.
yeah.
Amazing. Good. And you and I have been talking because you've been making some trips out to Fort Worth. There'll be more coming this year. I think it's important for anybody in our audience who are in either of those locations, like Ed's local, and you can get in touch with him and go shake his hand and meet in person. So with that said, tell me a little bit more about ClientFirst Wealth Management, the firm. Maybe what do you guys specialize in? Who do you kind of cater to?
Sure.
And then we'll dive into your thoughts on the markets. But tell me about the firm first.
Okay. ClientFirst is an SEC registered investment advisor firm managing close to 300 million now, with about 100 accounts. The focus is on planning, and we do offer asset management as well. But we focus on pre-retirees and retirees, and just helping folks make that transition, you know, financially, psychologically, and it is a continuous operation. It's not a one-time financial plan and check in every 6 months. It's ongoing, and I have a very close relationship with clients. A lot of them I've had relationships with for 30 years and now work with their children, and even some of their grandchildren are managing money for some of their grandchildren. And so it's a close-knit family type environment with respect to clients. And I also specialize in fixed income management. So that really buttresses the retirement income function of the retirement planning that we offer, and tax-free bonds, for example. I've got a long history in that area. But for growth exposure, which everyone still needs in retirement, certainly, the S&P 500 type stocks are the work engine. I call that the Christmas tree. Everything else is sort of an ornament, you know.
Yep.
So nothing too jazzy, just something that, we can monitor and control to the extent possible, the volatility, and just make
Sure.
sure that the plan fits the circumstances, especially as they evolve through life and we go through life's changes and just try to buffer clients from worrying about their money running out. And
Sure.
that's the biggest concern, today.
Totally makes sense. And it's actually a great segue into I want to talk and hear a little bit about your thoughts on the market, right? Because actually yesterday and today have been a little bit volatile, right? But tell me about like, this year we speak to a lot of advisors and like, man, Liberation Day, early April, that was like an interesting moment, but then there's been a nice rebound. There's
Yeah.
some volatility entering the markets the end of the year. Just like 30,000 foot view on the markets this
Yeah.
year, and maybe then next, just some thoughts that you have
Yeah.
heading into 2026.
Yeah. I mean, April, the 20% downdraft and then a 10% rebound in a day was, with respect to the S&P, was a really, an unusually volatile point in time. And I think a lot of institutional managers got trapped. They didn't get back in. They maybe had to meet distributions, if selling pressure in mutual funds and what have you came about. And then not just the mutual fund industry, but hedge funds and what have you. So the retail stayed in and the retail bought into it. And so you've got I've been doing this a long time, Brooks, and I can't remember a time when the institutional dollar has underperformed in a market like we've had. I read, I think yesterday or the day before, that 22% of active managers are underperforming the index. Well, that tells you they're not fully invested. And so they've got to get there before you're in. So I'm thinking, we're probably going to have a chase going into year end, but there's so much in gain now, unrealized cap gain. We may see a repeat of what we had several years ago in that. And I'm sure you could tell me which year, Brooks, but so the market took a pretty good dip in January because everybody took their profits and they have a whole year to try to, wash the gain
Right.
uh, and mitigate tax liability. So to me, that with the Fed backdrop, now I know you look at Fed fund futures and poly market has dropped as of yesterday. The probability of another Fed cut in December from what was around 75, I think now it's around 51, 52.
Yep.
But look, it to me, I think the Fed is just such a cautious body to begin with. They don't have uh, government data now because of the shutdown. And they're not going to have clarity other than anecdotal incidences of layoffs and whatever they can cobble together. So I think they're talking cautious, but I think they're leaning toward the cut. Because why do I say that? I don't know, but I think that I know that Powell said in his last conference that a few months ago, he's talking about squeaky wheel will get the grease. If it's inflation, we'll address inflation. If it's a weakening economy, we'll address that. So we swung toward the weakening economy, and I think their dual mandate. He's now leaning in that direction, but I think they're with their as they do. They send governors out and they make commentary, and they've sort of tempered the enthusiasm for the December cut. But I think we'll get it. And then on into next year, it looks like an easy money situation to me. And that ought to mean a weak dollar. And I think that between issuance of the Treasury bonds, say the 10-year benchmark for mortgages, I know the present administration wants to get the mortgage rates down, as do a lot of folks. And there several ways you can go about doing that. One would be to curtail the issuance of a 10-year note. And then if you get a little help from the Fed on the short end, lowering rates, there'll be some gravitational pull on the 10-year in conjunction with maybe some curtailed issuance. Maybe you get down to 3.5, 3.25, and all of a sudden fixed mortgages are, 75 basis points lower in yield than they are now, and that will be enough to stimulate some activity. So that's kind of what I see, and I think any asset is going to do well in that environment. And so often we see, a lot of correlation among asset classes, which is not necessarily a good thing, but stocks should do well with a lower interest rate backdrop. A falling dollar is good. Maybe as much as a third of the companies in the S&P 500, or a third of the earnings could be attributed to sales overseas.
Yep.
That benefit from a lower dollar. So I think there's a tailwind there. The bonds, I don't appear to want to throw a tantrum like they did a year ago when the Fed cut. The 10-year note went from 360 to 480 over the course of 3 or 4 months. We're not having that kind of reaction now, so it's pretty accepting of what's going on. So I think we're okay and a year in, and then maybe a dip in 26, and probably buy the dip because we're going to continue with an easy money policy.
Super fascinating. I love speaking to advisors such as yourself, kind of get your thoughts on the market, maybe what you're hearing from clients, and you ended on fixed income, which is a great segue into really what I think big part of this conversation today is about. And, I'm just going to kind of walk through how we teed up the webinar. I wanted to walk through what you and I were talking about, which is potentially one of the most misunderstood risks in the muni market right now, the de minimis tax trap. And so this is a rule that most investors have never heard of, including myself, but one that can convert what investors thought was tax-exempt yield into ordinary income taxation when the bond matures, is sold, or called. And so I want to kind of turn it over to you, but before I do, I think it's especially relevant if you bought individual munis in 2022, 2023, when prices were depressed, yields maybe looked incredible. Many investors who got in at this time might be sitting on a future tax bill, but that they didn't even know exists. So maybe just kind of like, give the context to start. Munis, maybe what is this potential tax trap? And then we'll kind of get into a conversation from there.
Sure. Well, first, let's rewind back to several years ago when the interest rates were near zero. Then the Fed embarked upon a pretty torrential hiking campaign. Well, back when the interest rates were zero, in Arkansas, for example, a school bond is sort of like the bread and butter, best credit there is. There's a state backing, and 10-year school bonds, let's say we're paying 1% and trading at 100 cents on the dollar. Brand new bonds issued 1%, 1% tax exempt. Okay. Well, when the rates go from 1% on the Treasury, for example, to 5%, which they did, the value of the bonds fall. And so whoever bought that bond at initial issuance paid 100 cents on the dollar, but if and when they exit that bond, they sell it at a steep discount, the new buyer buys it. And the de minimis rule has been around for a long time, but it really didn't rear its head or become a problem, or hasn't in the past, until you have a significant rate rise. And you see situations where these municipal bonds are now trading at a deep discount. For example, let's take a 5-year bond with a 2% coupon that was issued at 100 cents on the dollar. Now it's trading at 86 cents on the dollar. So at par, at issuance, it yielded 2%. Now it yields 5.0, 5.10, actually, the bond I'm looking at. So bond broker calls and say, hey, Brooks, I got a great offering for you. how about this? How would you like to earn 5% plus on a tax-free Arkansas school bond? And so, these poor savers have been subsidizing the borrowers for 10, 12 years as the Fed remained at almost zero. They've been in the desert and they're thinking, hey, it was 1%, a
This looks
couple of years
pretty
ago.
darn good.
Yeah, here's
Yeah.
five. It's five
Yeah.
times better.
Yeah.
And I'm not casting aspersions on the salesperson. This is something that a lot of people just don't remember this being a problem. Even the CPA community, I've spoken with a lot of them, and it's normally beyond the scope of their engagement anyway. But let me set this up for you. So the 5-year bond trading at 86 cents on the dollar, the de minimis rule says the entire discount from 86 to 100 is subject to ordinary income tax.
Yep.
Ordinary income tax. Now, normally, if you're buying a tax-free bond and you're avoiding de minimis, you're not buying at a deep, deep discount. Say you're buying that same bond at a slight discount. The difference between what you paid and 100 cents on the dollar when it matures or gets called would be capital gain. You held the security for a year and a day, it's long-term capital gain.
Right.
No, not with de minimis. And that's where a lot of people get confused. They think, well, that's capital gain, the difference between 86 and 100. No, it's ordinary income. And look what this does to your yield. You don't have a 5.10 yield. You have a 4.00 yield.
Right.
So, it's a 20% difference. And the trick is here is you don't learn until maturity that you have a problem. So until that bond is matured, has matured, or gets called, that is when the tax is assessed.
Right.
So your accountant's not going to know. And if your financial advisor is not on top of that, they're not going to know. No one's going to know until when you get your 1099 and you give it to the accountant, he goes, hey, that $100,000 block of bonds you bought at 86 cents on the dollar you were crowing about, and what a great deal you got. Well, guess what? $14,000 is subject to ordinary income tax, and you're in a 40% bracket.
Right.
And so that's the issue. And so how do you address that? It's easy. That's the good news. It's really easy because now the market's giving us an opportunity where rates are not dissimilar from where they were or have been. You've got about a 4% on a 10-year benchmark treasury. I know we're talking about municipals, but that has a huge impact on all bonds. But that 10-year sector, that 10-year got up to about 5% about a year and a half ago. And now it's back to 4. So here's the strategy. You sell the bond that I mentioned at 86 cents on the dollar. There is accretion. This gets a little wonky. There's accretion. Maybe it's accreted to a dollar price of 90. But you go ahead and sell that. You exit that and you reinvest in a full coupon bond. What does that mean? Whatever the new bonds are paying now, which might be 3.5 or,
sure,
or slight premium. And then you avoid not only ordinary income tax, you avoid capital gain because you're buying a full coupon bond. So you've defeased the tax bomb that is caused by the de minimis rule. And it's an obscure thing, but it's affecting a lot of people that I've run into. And one of the things I do is I'm open architecture. So I'm buying bonds from a host of broker dealers. And if you're dealing directly with a broker, and even if you want to have a discussion with your financial advisor about this, the true yield in my example that I just gave you is 4%. Always ask the broker, what is the true yield? Because they might not have considered it. They may not be paying attention that it's de minimis, affected by de minimis. And so on a Bloomberg, they can press a button and it will give the true yield. And that's how you defend yourself against this problem. Now, it doesn't mean you don't buy deep discount bonds. You can buy them as long as the true yield is higher than what you could get in a current coupon environment. Yeah. So a par bond, for example. So again, I preface this by saying it gets a little wonky, but bottom line, always ask about the true yield. And if you already own these bonds, talk to your advisor about selling them and replacing them with bonds that are not subject to de minimis.
The swap is interesting because it actually almost sounds, I mean, in theory, almost like a 1031 exchange with real estate.
Mhm.
As long
Mhm.
as you, right, have
Yeah,
you know, if you do have these kind of capital gains, as long as you reinvest in a certain amount of time back into an income producing asset, right, you can defer some of those. I'm assuming it has to be bonds for bonds. And to your point, I think you made it's a full par bond that you would have to get back into, correct?
right. To avoid the
Okay.
de minimis. Yeah,
Yep. Okay. And then what, you've mentioned you see this with some of your clients, and you also at the beginning of our conversation, you were saying you do focus on retirees, pre-retirees. Obviously, we don't need specific instances, but how is that affecting this specific cohort? I'm assuming it's just, the simple fact that they have been looking for relatively safe current income producing assets. But
right.
to the point, they're not going to end up with as much as they thought they might because of this tax implication.
Exactly. Well, so many the clients we serve, so many of them do not even need tax-free municipal bonds. There's a segment, I'm going to say it's 30% of the book, that is consistently in a high enough tax bracket to really need them. So they're north of 30% tax rate, or north of
Sure.
25, 26% tax rate. So you've got that, because what I typically see, and this is not directly on point with your question, but what I see a lot of, what we see a lot, is people that have 85, 90% of their savings is in their 401k or their 403b. So they don't need tax-free bonds. But there are more fortunate folks out there that do. And yeah, you can step in front of this and you see the train coming down the tracks, the tax liability that's going to exist at maturity. You cannot do anything about the accretion, the difference between 86 and 90 in an example that's already occurred on a 5-year bond. So, the way accretion works is we take that 14-point discount and amortize it over 5 years, because it's a 5-year bond, whatever that comes out to. And I can't do that in my head. I'm sorry. But you would look at that and say, all right, let's just say that's 90 cents on the dollar. So that's water under the bridge, the difference
Right.
between 86 and 90. Can't do anything about that. But I can defease, if you will, the tax liability between 90 and 100, instead of just sitting here for another 4 years and getting pummeled, with ordinary income tax at maturity.
Yep.
But what are other people doing? You've asked the $1 million question. I wish I knew. I can tell you, just by monitoring the secondary market in municipals, a lot of that paper placed. And you have to think a lot of it got placed with individuals. Some of it, I'm sure, got placed with institutions. And if it's with a mutual fund, um, you know, everything flows down to the individual in a dividend. That's tax benefits and tax detriments. So it affects a lot of people. I don't have any statistics on it. I wish I did.
Yeah. Well, so this is a question I have for you that connects kind of like maybe the micro in terms of portfolio construction to maybe some of the macro that we've been discussing earlier in the conversation. Specifically rate cuts in my mind, but this is where I'm interested to hear what you think. So what catalyst in the upcoming 1 month to 12 months could maybe make this sort of risk matter a lot more? Rate cuts, credit concerns, a recession, like how could this actually be exacerbated by some sort of catalyst in the next 12 months?
Yeah, all of the above. I mean, because we could have, once the government statistics start uh, being released again, you could have inflation.
Yeah.
And then that's going to temper the Fed. Now, okay, you can say, well, in May, Powell's out, and you're going to have somebody easier in that seat. But here's a scenario. What if you had a repeat of what we had a year ago when the Fed cut, I think it was in September, about 50 basis points. And I mentioned this earlier, you had a 10-year note with a 360 yield. And over the following months, it went to a 480, 482. So you could have a repeat of that. So to where the short end is coming down.
Yeah.
You've got Powell replaced, but the longer end is going, I'm not going to put up with this. You're going to have to pay me more to accept these short bonds, to accept this inflationary environment you're creating by lowering these short rates, Federal Reserve. And so then maybe just to muddy the waters more, maybe the Treasury steps in and goes, we're really curtailing the issuance of 10-year bonds. And that's what's going on now. They're shoving it all into the shorter term. The advent of the stable coins, just we're financing our long-term debt with short-term debt. I mean, that's what we're doing. Our long-term deficit with short-term debt. So, that's a risk. And of course, if rates go up, it won't be good for the stock market. The 10-year equity models will have a headwind, an extra headwind. Here's the thing that's starting to bother me, Brooks. It just started, like maybe a day or two ago, but the spend on AI, the hyperscaler spend, okay? So you take the Metas and the Googles, and they're all spending so much money. And you've had people, if you look at the surveys, are people worried about the stock market, thinking, oh, it's going to be another 2000, where these stocks are way overvalued and we're going to get a really bad spanking. Okay. The difference is that these companies are well heeled. They have earnings and they've been funding the spend out of cash, out of current cash flow. Now they're starting to borrow money.
Mm-hmm.
And that bothers me because we don't know the rate of adoption. We don't know who is going to take market share, who's going to lose market share. And so I see, potential risk out there in that area because those stocks make up such a huge percentage of the indices, the S&P, the NASDAQ, and they're trading at pretty rich multiples. Some would argue, well, NVIDIA's trading at a lower multiple than Costco. And that's true, but still, as a whole, you're fairly richly valued up here. And if you have any narrative that comes around that undermines the idea that, okay, the Fed's going to ease and these stocks are going to go to the moon, you could have a problem. I mean, you need to look no further than back in April. Remember the DeepSeek moment?
Yep, of course.
When for $6 million, it appeared on first blush that maybe this company in China, I think it was going to be able to accomplish largely what the multi-billion-dollar spends were, accomplishing. And then only after a few weeks did we see, no, it's much lower level, and we kind of breathed a sigh of relief. But that narrative was in question all of a sudden. And man, when you're suspended and the narrative is compromised, it can get ugly in a hurry.
Totally. Super fascinating. One final question on the muni topic, and then I have one more kind of general question before we wrap up.
Sure.
If someone owns like muni ETFs, do they face the same risk, or is it different from individual bondholders?
There is a flow through of that, like with any fund.
Sure.
What the fund experiences is distributed out, to the individual shareholder. But here's something that may interest your viewers in the context of muni ETFs. If you're in a state that, let's take Arkansas, for example, perfect example. We don't have an ETF in Arkansas for Arkansas municipal bonds. Why is that? We don't issue enough paper to really be able to facilitate the mechanics for distribution and for an ETF. So financial advisors who want to provide tax-free municipal bond exposure to their clients, put them in an ETF. Well, that by necessity means, I'm going to say 90 some odd percent, maybe 98%, maybe 99% of the bonds in a given ETF may be issued by states other than Arkansas, which means the Arkansas resident is going to pay state income tax on all of the dividend income. Or if they own outright municipals individually in other states, they have to pay state income tax on the income. So what I've been encouraging people to do is take a look at the individual tax-free bond portfolios that we manage. I don't care if you're in Arkansas, Kentucky, wherever, states that don't have ETFs. And an ETF is easier, it's more liquid, and you know, if you're in a state like Texas or Florida or New York, fine. But states that don't issue ETFs, look at an advisor who will construct and manage a portfolio of individual investment grade bonds in your state, because the income will be free of taxes. And also, you're going to support in-state issuers, school districts, hospitals, roads, water systems, bridges, as opposed to sending your money all across America and supporting other states. So it makes sense on a lot of levels, and that's something that I'm glad we touched on.
Yeah,
it's good.
Good. No, I was curious about that coming into the conversation, and I think this has been amazing for me and hopefully very valuable for our viewers. The final question that I have, again, zooming out, we're nearing the end of the year, about a month and a half left. What is, and I know you and I spoke about this, every person has a different risk tolerance, different situations in their life. And so it's hard to kind of answer this, but what's your highest conviction, trend, holding, etc. over the next 12 months?
Highest conviction is that we are going to see interest rates fall, the short end. And I say it's highest conviction because we can see when Powell gets replaced in May, you know, it's been signaled we're going to have an easier Fed. I don't know, like I said earlier, what that'll do to the longer end, but it knows that. If I sit here in Little Rock, Arkansas and know it, the bond market knows it, and it's fairly sanguine about what's going on right now. But I feel like, you know, stocks, the S&P 500 should do well. Maybe smaller cap, mid cap stocks, and that's where it may pay to have active management, because you know they're more selective, and active management tends to earn its keep more in the smaller cap market. International, distressed debt, those are the areas. The old saying with respect to the broader index funds, what everyone knows isn't worth knowing, and so say those, that's the Christmas tree, and everything else is an ornament. But the Christmas tree is going to do well, the ornaments are going to do well. Crypto is probably a decent thing to consider here, but be careful. Talk to your advisor about it, and in the right percentages can make some sense. So that's my conviction is risk on for the next for the foreseeable future, with the one caveat that we may get a dip in January as people wait to take their capital gains. But that could be a buying opportunity. I hope it is.
Good to know. I love it. Awesome. Wonderful conversation, Ed. How can people find you? How can they get in touch with you? We'll have a recap of this and also some accompanying content. But if anybody wants to reach you, how it's the easiest way to do that?
Well, email ed@clientfirstwm.com, and the website is clientfirstwm.com or clientfirstwealthmanagement.com. Just go to the website. If you want a discovery meeting or just have a chat, just schedule it. I'd love to visit with you. I'm not hard to find.
Good. Awesome. Well, thank you again for the time. You and I will be in touch, and we'll go from there.
Thank you so much, Brooks.
All righty. Have a good one, Ed. See ya.
You too.
Bye.